Hey everybody, is it Friday yet? Morning Kay.
Good morning, Ryan. Good morning, everybody.
Hope everyone's doing okay. Welcome to the Flow Show on Thursday. A little bit to talk about today, a few bits and pieces. I want to get a bit of ranting off my chest as well. So we'll start with the usual news roundup. Not a lot really out of China overnight that I could see anything of real note. There's a story out that they're potentially going to issue 1.5 trillion won's worth of new debt for investment purposes. Another part of trying to stimulate the economy, put money into various sectors, various areas, infrastructure. It's part of what we've heard in previous weeks, so it's not anything really new, but we're now starting to get a few numbers thrown around on that. We've had a couple of speakers out overnight as well, central bank speakers. RBNZ's or said the economy is in a robust enough place to handle higher rates. So the insinuation is that they're hiking, as we pretty much knew from the meeting earlier this week. ECB's Kazakh says inflation is still too high, and thus they will keep hiking, keeping the message going there. And ECB's Schnabel as well. A couple of interesting comments. She said a recession on its own would not be enough to control inflation. Obviously true enough. But the other key point she said was that the CPI concerns that they had before July have not been alleviated. So that, again, keeps the ECB in hike mode, that they're not ready to, or they're going to keep a strong hike path, at least keep it on the hawkish side. She also mentioned that a number of indicators are now pointing to a risk of inflation expectations becoming de-anchored. Now, this is quite a big line because the ECB is very much about inflation expectations. They want to see expectations anchored, and if those get loose, that's potentially a signal for them to turn perhaps more hawkish. They want to keep those expectations firmly on the ground. This is the reason why I tend to watch closely the Eurozone economic sentiment data that we get out, because it contains CPI expectations as well as selling price expectations. It's probably the closest economic data we get indicating those, and it's always been something that I've kept an eye on. They obviously have been running really high at the moment. I think they dipped a tiny bit last month, but still running very hot. But the ECB, as I say, are all about expectations for inflation. So if they start to get worried that they're becoming de-anchored, people thinking that inflation is going to run rampant, going to run hot, it potentially will push them to a more hawkish stance than they're at the moment. So one to keep an eye on there. Going back to some of the data, let's have a quick look at that. And obviously we'll touch on the FOMC minutes as well. Just having a quick look back at yesterday's stuff. We've got a bit more housing data, and obviously the retail sales. The NBA weekly data came out a bit softer. This indicator must be something to do with me, because the 2 weeks I was off, it printed positive numbers for the applications, and we saw a rise in the other metrics as well. And as soon as I get back, it starts turning negative again. So maybe I'm some sort of reverse indicator. Anyway, it keeps the softness in play there in the housing market that we've seen. No reason to see anything change in that respect. Now, the retail sales came in yet again positive. I don't know how many months now we've seen positive retail sales on the headline number. But obviously, as I mentioned yesterday prior to the number on the show, everyone will be looking at the adjusted sales. They came in pretty flat across the board, I think, but the core sales were slightly up, and that's the control group there. So I think 0.8 was the headline number, but when you take that for adjusted for inflation, they were slightly up as well. So a bit of a positive spin there from the US consumer, showing they're not struggling wholesale at the moment. That plays into some of the other data we're seeing that's a bit more positive. Jobs are obviously still strong. as well. Manufacturing, as we saw on Monday, the Empire State numbers declined there, real big drop. We get the Philly Fed manufacturing today. That'll give us our second indicator for the manufacturing sector. So as we've been mentioning, we're watching all these different sectors, all these different areas, marking them, giving them a score, if you like. Are they fulfilling the Fed's prophecies that they want to dampen demand? Some areas are, some areas aren't. And that plays right into the FOMC minutes that we're going to talk about in a moment. So just looking at some of the data out overnight, Aussie jobs came in on the soft side. The employment change was lower by just over 40,000 from plus 25k expected. Full-time employment doing a real big drop there, nearly 87,000 drop there. Now the unemployment rate dropped as well, which ordinarily you'd think is good news, but that largely came because the participation rate dropped. As you know from if you listen to the show previously, when we talk about the NFP and unemployment, the participation rate is an important number to keep an eye on when looking at the unemployment rate numbers, because that can affect the number. So here you can see a good number. It looks a good number. It dropped by a pip, but the rest of the employment data was rubbish, and the participation rate was the driver. So as people come out of the jobs market or looking for jobs, there's less people unemployed because they're not officially counted anymore. So that's why that rate can drop. So this is one of those moments where dropping the unemployment rate isn't the good news it looks like. Right, so let's get into the FOMC then. A lot of headlines coming out, and one of the things I want to have a little rant about is that some of the comments I've seen coming out saying that the Fed, they turn to a more dovish slant. Now I've got a little bit of a bug with this because I find that the market is always looking for the Fed and other central banks to be dovish. I don't know if it's because of the last 15 odd years or however many long where central banks have been dovish, but it seems that every time there's something that's not as hawkish, it's dovish. And to me, that's wrong, because let's take this example. A lot of the market and the headlines were pointing to the fact that comments in the minutes that they may slow rates at some point, and the market is playing the balance between whether they go 75 or 50. Going from 75 pip hikes to 50 pip hikes isn't dovish, it's just less hawkish. Dovish by definition is when a central bank is easing, or where policymakers are looking to ease policy, loosen policy, cut rates, inject liquidity, QE, that sort of thing. So when I hear dovishness, it just, I don't know, it pulls my strings a bit, because it's not dovish. Going from 75 to 50 is not dovish, it's just less hawkish. But that's just my little bugbear. But even so, there is a general feeling I have that the market is always looking for Fed to pivot and to turn less hawkish, and whatever they call it, turn dovish. But if you look at what the Fed are saying, they're pretty straightforward with it. And so if you go through some of the headlines from the minutes, and I'm just taking off what the wires have reported. One line said that the Fed saw a risk if the public start questioning the Fed's resolve. That's very important for the Fed. It's the same as ECB when talking about keeping inflation and expectations anchored. If the public don't believe that the Fed can do this, that's going to potentially create bigger issues for them. So that will, if you like, steady the Fed's resolve, or cause them, to really carry on going ahead on their path, because they need to prove to the public that they can get this under control. That's not dovish. That's not unhawkish, whatever you want to call it. That says to me the Fed are going to keep ploughing on. One of the other lines that was there that I think is important is that they say they're yet to feel the bulk of the effect of tightening. So for all the hikes they've done to this point, they're not seeing the effects they want to see. They're not seeing the jobs market demand withering away. Yes, they are seeing parts of the economy, housing as we well know, but they're not seeing wholesale demand drops in any of the other areas. So again, that to me says they're not going to deviate from the path. They're not ready to stop hiking. They're not ready to call an end to it or pick a top to it. We got the usual line that they could hike more than necessary or slow the pace of hikes at some point. That's pretty much what we've heard all the way through this. But again, another what I would call a hawkish comment is that they said that rates would have to reach a sufficiently restrictive level and remain there for some time. So they're talking about keep getting rates higher, keep moving rates higher when they get to whatever their terminal level is. I was looking at it yesterday, and they're roughly in about the 3.25 to maybe 4.25 mark on the last dot plots. I think potentially there's a risk that moves higher at the next FOMC. But anyway, that's the area they want to get to, and they said they want to get up there and they want to remain there for some time. So that means that these hikes that we're getting are going to stay in the Fed for longer than perhaps the market is expecting. They're not going to touch a high point, say, of 4.25%, and then the next month start reversing. They could stay up there for quite some months. And again, this is another hawkish, if you like, comment from the Fed, or at least a comment reaffirming that they are going to stay on this path. And again, I see nothing dovish or unhawkish in any of these comments that are coming out. And then they talk about jobs, and they say that the labour market suggests strong activity that's been implied in the Q2 GDP data, and there might be upside revisions. So again, they're not seeing any weakness in the jobs market like they're trying to push for. And in fact, quite the opposite may happen, is that the strong labour market may increase activity. And that is almost like the opposite of what they want. They want to see activity dipping a bit. They want to see demand dropping a bit. But they're realizing that the strong jobs market may lead to increased activity. If people coming into the jobs market, if people are getting jobs, that's a boom for the consumer. They're going to keep spending. There's more taxes to pay. You know, firms are still hiring. They still feel comfortable in hiring people. They've got money to hire. They're doing the business enough to hire more people. You know, that's good for the economy. And this sort of what makes the whole situation a bit bonkers is that everything or a lot of the data and the fundamentals are still pointing to a strong US economy, but you've got a central bank who's trying to dampen that down a bit. They're trying to do the opposite of what they've been trying to do for the last 15 years, which is try and boost the economy. So it's all a bit messed up in where we are in this situation in the world, but that's where we are. So my view of the FOMC minutes last night, the dollar sold off. We got a little dip in the dollar over it last night, as you can see here. It's probably one of those times where I wish I was actually sitting at my desk for the minutes. I tend to ignore them these days because they don't tend to be market moving, but this one was a market mover. And the market, again, as I say, it's trying to grasp onto any dovish comments or less hawkish comments, because it wants to know when the Fed's going to turn around. But you know, that dip's been bought, and you know, here we are back at sort of roughly unchanged on that, and it just tells you that the real market is saying the Fed are still going. You know, they're not going to stop anytime soon. So we've got a bit of a fight between those market doves and the market hawks. Kay, what were you were up for the or you were around for the minutes? What do you make of it?
Yes, I am. I was around, and I bought dollar yen at 134.90 on the dip. So
very nice.
Yeah, I saw the same thing as you. That is nothing in one word. And the market, I've been saying that for several sessions, and also in the chat room. I said the market is trying to cling on to anything where they can to possibly sell dollars, or now the last couple of sessions also trying to cling on to anything to buy euro. So euro dollar had a bit of a jump, dollar yen had a bit of a dip, but it was all relatively short-lived. So to me, nothing's changed, and I'll take this opportunity to repeat what I've also been saying a couple of times already, is that we are now nearing the end of August, going into September, where the Fed will double QT. So they don't really have to be any more hawkish than they are now, because QT is going to start to do part of their job. And I'm not saying it's going to happen, but I wouldn't be surprised if all of a sudden, half September, the market completely flips on its head and start to shout about dollar liquidity problems because of QT, and then we'll have like a dollar which all of a sudden trades 3, 4, 5% higher, and same panic goes the other way around again. So no, I haven't seen any change in what they said in the minutes, and again, it's down to what Bloomberg wants to report, put the red headlines in there and things. But to me, no change in the minutes.
Yeah, and I'm beginning, just based on everything that's happened overnight with the market reaction to the FOMC, I'm beginning to wonder if there's going to be a good trading opportunity if and when the Fed finally decide to slow hikes. Because as I say, there's a lot of people in the market who are looking, like you say, clinging on to every reason to try and sell the buck. Now, the Fed are going to slow at some point. They can't keep going 75s forever. So there is going to be a time where they either pause or only go at 50 or maybe go down to 25s. And I think the market, once it gets that, is possibly going to overreact to that. So it will hammer the dollar, it will hammer yields, but that won't necessarily change the Fed's path in keeping increasing and getting rates higher and then holding them higher for a prolonged period. So I'm beginning to think that if we do ever get what would be classed as a shift from the Fed, or as I say, bringing down their hike path, only going 50s or 25s, if we do get a big negative dollar reaction on it, I think that's something I'm going to be looking at to buy, because I think we will get an overreaction on that sort of news. Do you see a similar case there, mate?
Yeah, but that's going to be a difficult call, in my opinion, if and when they start to pivot, because the reaction may be quite significant.
Yeah.
But I think we anyway, that's the timeline that I kind of have in my mind right now, and I'm not sure how it's going to develop.